Well, welcome everyone. Thanks for joining us today. Excited to have you join us for this new Financial Toolkit series. I'm going to start this afternoon. I'm Pauline Van Erden. You'll hear from myself and Denny more here as we go through the day. But to offer welcome greetings to start, I'll have Pete Upton start with that this afternoon.
My name is Pete Upton. I'm the Executive Director for Native360 Loan Fund in Nebraska, and then I also serve as Chairman of the Native CDFI Network. So I'd like to welcome everybody on board, and I look forward to having some discussion and learning just as much as you guys are going to learn. So I want to thank Christopher Coburn and Sandy and everyone else involved for putting this together, because I think it's something that can greatly benefit native ag producers.
Thank you, Pete. Christopher Coburn, would you like to offer a welcome?
Sure. We're glad to have everyone with us again. We're excited about what we can learn, especially how to do Schedule F, to demystify it and see why that's so important for producers and possibly to qualify for other things. So we're really excited. I'm the CEO of Mvskoke Fund with Mvskoke Creek Nation in Oklahoma, and we've had a great relationship with Native CDFI Network and also with the Native American Ag Foundation. So Sandy, thank you for being on the call. Thank you, Center for Farm Financial Management, for bringing your expertise to bear. We appreciate that greatly. And we're just looking forward to growing with you and getting capital where it needs to be. So thank you.
Thank you, Christopher. Appreciate that. And Jackson Brassi.
Yeah, well, welcome. Great to see everybody. And thank you to everyone who made this training possible. The Financial Toolkit, this Financial Toolkit webinar, we think is really important, and again, will help our producers as they prepare their taxes for the year. And I think it comes at a very timely time. And one additional thing we'd like to share is that we at the Native CDFI Network are happy to partner with the Native American Ag Fund and our members like Mvskoke Fund and Native360, who are building out their agriculture lending programs. And this will be a big year, 2021, for growing those programs for these Native CDFIs who might already have an ag lending program, or those that are interested in expanding it, as the history of agriculture and Native communities runs very, very deep. So yeah, thank you.
Thank you. And Sandy, if you want to say anything.
Well, here at NAAF, I echo everything Jackson and Christopher and Pete said. These trainings mean a lot to us, and being able to partner with these wonderful organizations and Center for Farm Financial Management to put these on, and Denny and Pauline, this is very meaningful. And I do want to stress that these will be recorded and they will be placed upon our websites, and we will share all that information and any other information such as PDFs or PowerPoints will be available. So thank you to everybody.
Thank you, Sandy and Pete and Jackson and Christopher. Appreciate you reached out to us to develop this. So yeah, like everyone else said, thank you all for that. I will say, so I don't forget, I did share in the chat the handout for today. Like Sandy said, we will also post that along with the recording. So everybody will have access to those pieces going forward as well. So Denny, I don't know if you want to introduce yourself, that would be good as well.
Right. Yes, of course. Denny Everson, spent 37 years doing this thing called ag finance for agriculture. Loved every minute of it. I can tell you that I'm still very grounded to agriculture, because just 45 minutes ago, I was sorting calves to sell at the auction barn tomorrow at my family ranch. So I'm still involved in agriculture and very much excited about the opportunity to do this. to talk about the basics of lending, because that's where the root of it is. Some of it's going to seem like, oh gosh, this is pretty easy stuff that we already knew, but we don't know where everybody's education is on this. So it's fun to start with the basics, and Pauline will be carrying the load of it here, but I'm going to jump in every once in a while and maybe put a little color to how it happened in my bank or with my customers over those 37 years. So it's great to be here and great to be part of this program. Thank you.
Thank you, Denny. And I'll just introduce myself a little more here. So Pauline Vanderden, an economist at the Center for Farm Financial Management. I also have not quite the tenure Denny has, but had a stint in ag lending as well, and also taught farm business management education to farmers previous to joining the center. So have worked in this space a lot as well, and appreciate the opportunity to partner and offer this to all of you. So with that, I'm going to share my screen and we will get started. So bear with me here. And I will start my PowerPoint maybe. There we go. So, all right. So this series, as you all know, is talking about taxes and finance toolkit for you all to use and go forward with as you take a deeper dive into the finances of your operation, or maybe start to dip your toes into it as well if you're a newer producer. So hopefully you'll all find some use to this. But we are going to start this session with the balance sheet. It's the starting point of all the work we do in financial management and financing. So thought it is the best place to start. As we go through this 3-series session, we are going to talk about where you are, which is the balance sheet today, where you've been. So that would be the tax preparation, the Schedule F information, doing that past performance information to help you and perhaps help a lender take a look at your operation and the like I said, the past performance of it and the financial aspects of it from that point. And then in the last session, we'll talk about where you're going. So cash flow planning and business planning for the coming year, or even beyond that, as you may do initial business planning for your farming operation.
And the other thing I'd say is if there was a number 4 bullet here, you'd probably say, okay, where are you? Where have you been? Where are you going? And a little bit of what I'll talk about in that last session is, what are you going to do when you get there? Because it's an ongoing journey, but this is where it'll all lead up to.
Yeah, very good point. Yes. So where you are, today's topics, we're going to actually do a very high-level overview of record keeping in case that's a starting point that some of you are at and needing to get organized. So we'll talk just a bit about that. We'll spend the majority of our time on balance sheet preparation and how to set up your balance sheet and the components of it. And then we'll talk just a little bit about analysis basics, and we'll point you to some tools in the 3rd session as well if you need to do a deeper dive into any of these topics as well. So to start out, like I said, record keeping here. First of all, who are your records for? That may be something you've never thought about, or maybe you've already thought a lot about it and prepared records and use them for different things. Oftentimes our records are first and foremost for ourselves and for our operation and our own internal planning. We may use them for other things like giving them to our lender, filing a Schedule F perhaps, or working with some sort of advisor in that process. I'd also challenge you to use your records more for your own financial analysis and financial statement preparation. And part of what we talk about today on the balance sheet will actually, your records could help pull that information together. So, you know, it's always good to think about what you're doing, the activities you're doing for, and what they may be useful for.
You know, when you've literally bought into the process of good record keeping, when you decide that you're the one excited to see the bottom line instead of perhaps the lender, who always is interested in those numbers, or even your accountant or your own, if you do your own taxes for, okay, did I pay any taxes or not? It's the big deal is just, where's my operation going? And I think this records piece is so important and can't be overemphasized.
And as you do that record keeping and financial analysis and planning on your operation, you know, there's several ways you can look at all of this, certainly from a whole business level, the big picture of your operation, but you can dig into the enterprises as well. So Denny talked about sorting cattle. So looking at the cattle enterprise versus the cropping enterprise, perhaps maybe it's the other crops you're producing, whether they're a fruit and vegetable type operation or more of a commodity operation. So you can certainly take a look at, dive into the enterprises and the deeper look at things to look at what's making money, what the right direction for the future of your operation is. Like I already said, for that big picture business planning and like Denny said, future planning for the operation, and also preparing the financial statements. We're not going to talk about all four of them in depth in this series. We're going to focus on the balance sheet and income statement or Schedule F, and then cash flow planning, but hopefully give you an idea of the major components of each of those. Then types of records. So there are several types of records, of course. We're going to focus and we're talking a little bit about accounting and business records at this point, whether it's for the farm business or you individually. I know I keep records, keep tabs of our personal finances for our household, and I'm sure many of you do as well. So there's certain types of accounting records, of course, within that. And then other records that you're keeping within your operation as well that are useful in all of this and help with that roadmap and that planning. Production records of whatever the commodity is you're producing in your operation. The marketing records, so how are you selling the product you're producing? And then other risk management records, whether it's insurance, is a major one that comes to mind, but there's certainly different levels of risk management and different records that go along with that, whether it's a transition plan as you look to move that operation to the next generation. There's just several types of records and statements that you'll use along the way. Then just a quick talk about what is really a business expense. So looking at this picture, it's pretty obvious that this is a farmer that has seed that they're putting into the ground. They've got fuel to run that equipment, fertilizer, likely chemicals, the purchase of that tractor, so the depreciation and perhaps interest to finance it all are pretty readily recognized as a business expense, and those are the easy things, right? It's producing the commodity that we are trying to sell within the operation. Sometimes it gets trickier though, like in this example. So here, this producer is bottle feeding some calves. So you might say, well, that's a business expense, and it certainly is. But as we think about how we create that bottle of milk for that calf, we're using hot water probably in that process. And that hot water also helps us take a shower within our home and all of that. So there's sometimes that gray area as to where what's personal and what's business. So you may need to consider that for things and what expensive portion of some of these things to the business, and recognize some of it as a personal non-deductible expense as well. So common things along that same line, cell phones, certainly you're using that for business, but there's probably also a personal component, vehicles, other utilities, just to name a few. So thinking through that process as you're gathering your receipts and your expenses and doing that record keeping becomes important along the way. Then how do we compile records? Things you're already doing, I'm sure, taking a look at your checking account statement, keeping receipts and other production expenses. If you do have any loans already, those loan statements to help determine principal versus interest, invoices from sales, for that commodity that you're producing. So those are all means in order to compile those financial records for your operation, and there's certainly others as well. Those are just some big broad categories there. Some helpful tools. So we would probably recommend that you think about some sort of software that helps with that process. And there's several different options on the screen just to give you a few ideas. Some are more farm-based, like PC Mars here has farm within its title there. And some are more broad-based, general use, like QuickBooks and Quicken. So there is no right or wrong system. It's whatever system works best for you. It's finding that and gaining that comfort level with it. There's certainly different price points with some of these as well. So it's all of that is part of your decision-making system. You can also do things by hand. There's certainly nothing wrong with that. Software helps speed up the process a little bit. Or you could perhaps use Excel. So there's lots of options. It's, again, finding what works best for you in your operation. If you are considering those things, you could certainly go and Google the different softwares I just listed there. Or there is a nice piece by Iowa State Ag Decision Maker. Here you can see the link on the screen that just helps evaluate farm accounting software and gives you several ideas and talks about the pros and cons of a lot of these different tools. So if that's a point where you're at in your operation, certainly look to those tools to help make that decision in what's best for you in your operation. So that's a really quick overview on record keeping. We're not talking about the how do I enter it specifically into my records, but just wanted to give you a few things to think about as you begin that process. So balance sheet preparation then is the crux of what we want to talk about today. So what is a balance sheet? If you're unaware, a balance sheet is really a snapshot of your financial picture of your operation at a single point in time. So it's the foundation, like I already said, of the financial analysis that we'll be talking about going forward. And it's gathering that look at the business, what you own, those assets, how you've invested already in the operation. If you have taken on debt to do so, that would be the liabilities. So how is that debt and how the amount and how we list it on the balance sheet? And we'll talk about that going forward. And then what's left over? What is the net worth or the owner's equity of that, of your operation? So here is a quick picture of that. It is a balance sheet because things always balance out, and it is completed on a single date. So I can do a balance sheet today, and actually I could do another one tomorrow, and things are going to look slightly different, not major things, of course, on any given day if we compare to two sequential days, but a little more accrued interest, probably a little bit less supply, maybe a little bit less cash in the bank, all of those things. So it is certainly a snapshot on any given date. So as we begin talking about the balance sheet, we are going to start with the asset piece of that. So everything that you own within the business, and even personally, if you're a sole proprietor, can go on your balance sheet. So again, I didn't, I guess, talk about this on the previous slide, but as we think about that balance component, we're taking the left-hand side of the balance sheet, the assets, minus the liabilities to get to our net worth in this process. So as we build the balance sheet, we'll walk through this here and talk about each of these components. But to start, the right-hand side, the assets, what are all of those things the business owns, whether it's supplies, whether it's capital things like equipment or buildings, all of that. Then the liabilities, what debt is out there that we use to acquire the assets. And then lastly, the net worth. And again, this balancing feature, total assets will equal liabilities plus net worth. So we're going to start with the assets, like I already said. And as we think about the balance sheet, especially in agriculture, the assets and liabilities are divided into 3 different categories. So we start out with current things, things that will be used up or due if we're talking about liabilities within a year. So that would be cash in the bank, probably grain in the bin, livestock that we'll be selling, supplies, and those sorts of things. Intermediate are things that have useful life of 1 to 10 years, and then long-term things are have useful life greater than 10 years. So it could be land that you own or buildings, other things like that. So again, the current pieces there, I have a pretty comprehensive list there from cash and inventories that you may list out. Growing crops, so if you at this point had in your operation planted some winter wheat, for example, that certainly would be listed on my balance sheet today, even though I don't have that crop in the bin yet. And then another thing that can easily be forgotten are those accounts receivable you may have. So things that, money that people may owe you on any given day. For example, custom work that hasn't been paid that you've completed for somebody, or something along that line. So all of those pieces are something you would expect to collect on within the coming year and would be listed as a current asset. Intermediate assets then are those things, again, with that useful life up to 10 years. So machinery and equipment, breeding livestock, vehicles you may own, perennial crops, so fruit or hay may be some common examples, or other things that don't fit into our neat little box there. So there's certainly other examples that we don't have listed. And then long-term assets would be land and improvements, buildings. Certain perennial crops will be around longer than 10 years, so it depends on the type of crop. And perhaps other long-term things, co-op equities, some of those things would fit into that category. So the challenge, though, is we can gather the that laundry list of things that we own. The challenge may be, how do we value it, and what do we list it on the balance sheet as? So we'll talk about some of that here. Current assets, it's that current market value. So it's, what can I sell my crop for? What can I sell the livestock for? What did I pay for those supplies that I've gathered? Intermediate and long-term things, though, can be more challenging. So we'll talk about that going forward here. Growing crops, though, it does present some challenges as we think about that. So it's that crop that we've incurred some costs for, but we haven't been able to harvest and get the commodity from it. So valuing growing crops, our suggestion, and this would fall in line with Farm Financial Standard recommendations, for example, is to consider all the costs that have been incurred to start that crop off. So the seed, fertilizer, chemicals, all of those major input costs that you've paid for that that got us to the crop's point where it is on that date.
I would like to interject here if I can, Pauline. On that growing
Sure.
crop, never get real hung up on trying to, I mean, as Pauline said, it's really tough to evaluate it. And my suggestion to my customers was, don't get too hung up on that. It is as it is, a growing crop. And until it comes in off of the pasture, until it comes in the grain cart, that's what it is. And you don't really understand its value. Okay, input costs versus what's it worth today when you haven't harvested it yet. It's very difficult to analyze your financial situation with something that's in the middle of the production cycle. And so not to get too caught up in this. And the other thing is, that brings to mind is, you know, what we're talking about here in terms of valuing assets, again, seems pretty simple, but at the same time, I could take you back to how antiquated this whole process was in 1975 when I had joined the lending industry for agriculture. This has come a long way, and to talk about this and make sure that we cover these details is really important. But again, the valuation piece gets to be everything. And I know that you're about to get into market versus book value and all those things. And it gets a little more complicated, but just a little interjection there about, don't get hung up on that production cost stuff in the middle of the crop, or calf crop or a grain crop, whatever it might be. Thanks.
Yeah, great point. Do the best you can, but don't pull your hair out in the process, I think, is a good message. The other piece sort of related to that is once we have created or harvested that crop and have it in the bin, how do we inventory it at that point, or how do we value it at that point? So again, looking to local markets, I can look at local elevators if it's a corn or soybean crop, or wheat for that matter, or other methodology that you would determine to value that crop. So if it's not priced, certainly use that local going value for it. If you do have a contract on it, though, that's the best price to use, because that's what's been agreed upon, and that's what you should receive in that process. So some ideas here on the screen. Again, use your local resources in that process, especially if you haven't established a price or established contract on it at this time. Livestock held for sale, much the same way. That gets a little trickier. So that would be pigs, cattle, those sorts of things that I'm planning to raise and grow and then sell. So they're for market purposes. Looking again to local auction markets that are available where you may sell that animal in the end, or if it again is contracted, use that price. The tricky thing with livestock, though, is the fact that there's typical market weights that things are being sold at. So, a 280-pound hog, for example, and if my hogs today in my operation only weigh 220, well, they're not market ready. So it's a little bit harder to establish that value. So again, do the best you can. Consider some discounts for light or heavy breaks there, and try to establish the weight times that market price that's being offered to gather that balance sheet value if you don't have it contracted. Then, like Denny said, the cost versus market value on our non-current assets. So those are a lot of our common current assets we're going to see on the balance sheet. As we look at the non-current or our intermediate and long-term assets, how do we value those? We are going to mainly stick to market value in this setting. So taking a look at what I could sell that asset for today, what can I sell my tractor, my vehicle, whatever it may be for today, less selling costs, because getting that asset sold will incur some costs likely as well. So being conservative in that approach and considering those other additional costs. The flip side of that is using a cost or a book value. So taking the original purchase cost of that asset and taking off depreciation, or the amount of it that's really used up over time. My truck I use in my operation, the miles I put on it and the time that passes, certainly that truck loses some value. So that would be the depreciation side of that. Like I say, we're going to focus on market value here today just for simplicity. And that's typically, as you work on preparing a balance sheet for your lender, is the valuation of assets they are going to want to look at in that process. So,
comments. Always make sure that value is yours. The lender can certainly help you and consult with you on the valuations, but that balance sheet is, you own it, and those values that you put there, you support them, they're yours. So all too often, I would find certain customers, if not most of them, would look to me and say, well, what value do you want on there? Well, that doesn't matter. You own that product. You tell me, and we'll utilize it. If I, during the analysis of that balance sheet, feel that it's really out of line, I'll do that with my own analysis of it as I look to the credit, and then explain to the customer later why I think it should be different. But it's you own it, you value it. It's a good judgment process. Just use good judgment.
And I think that process has probably become a little bit easier on establishing that value the last few years, just with more websites available that are offering, you know, farm equipment for sale. I don't have to just go to my local dealership for some of that. So you can certainly look to those resources in that process. But you're right, Denny, you looking at it and finding that value is important. So again, talking about market valuation a little more specifically, trying to establish that fair market value. Also consider an arm's length transaction. So I may sell something to my children at a lesser price because I'm trying to help them out. So take those sorts of scenarios out of the picture and look at what you know, an arm's length or a typical transaction would be. And like we already said, consider selling costs that may be incurred in that process. Why does a lender like to use market value, and why may you want to look at it as well? Well, that's our best estimate of solvency, which solvency we'll talk a little bit more about, but it's what's the amount that's remaining if all of the assets were sold that you own and all of the debts were paid. So it's that leftover residual amount. So if we use market values, we're able to do the best estimate of that. The problem though, why we talk about cost as well, is that it's hard for us to tell as we look at our balance sheets, what did we earn there and what did we just increase the values on to make our balance sheet look better, the market value of things. So we're not going to go into the nitty-gritty details of that, but that's why cost value balance sheets have some value as well, because you can actually really dig into what you've earned from your operation. So market value balance sheets, how you can use them, again, evaluate solvency. It helps us evaluate debt capacity. Lenders use it for collateral analysis. So to Denny's point there, looking at their value of that asset and the debt against it, what's left over, helps us compare our operation with other farms, and also for estate planning when you get to that point. So what's the value of the business that I'm trying to pass on or provide to those heirs that I've identified.
Without getting too detailed, the other piece of that is under like the collateral analysis piece of this market value. It's not uncommon for the lender, after you have provided your balance sheet with the market value assets in it, and as they do their collateral analysis, it's not unusual that they might take percentage discounts to some of those asset categories, machinery and equipment specifically, especially as it relates to depreciation, and some other assets. And then, of course, they might also have another category or column, if you will, under the collateral analysis that literally analyzes it in case something doesn't work. And so you would call it a liquidation collateral piece. And so those market values are used in different ways. They stay what they are when they come to the balance sheet, but how people analyze them could be different. So you have to be aware.
So that's a quick overview of assets and how to value things and how to think about that in the process. Next, we're going to move on to liabilities. So it's all those things you owe, the debts outstanding and those sorts of things. So again, back to our graphic of a balance sheet. Just like the asset side, there's current, intermediate, and long-term liabilities or debts as well. The things that fit into those categories, current is probably the one that's slightly different here. So it's everything I owe within the coming year, accounts payable. So if I have a bill outstanding at the elevator or with some vendor, that's an account payable, and that's something I need to list. accrued interest, whether it's on an operating loan like we see on the list or other loans, longer term loans. Those are all considered things that will be paid in the coming year. What other accrued expenses, whatever they may be, can be added to that list as well. And then, I think I lost you all. Current liabilities, just to, the last piece here would be principal due on term debt. So even if it is a longer term debt, an intermediate or long-term debt, also then that principal that you will have to pay in the coming year is considered a current debt as well. Then intermediate, just like or just like on the asset side, it is a loan with an original term of 1 to 10 years. So those would be listed as an intermediate debt, and that portion that's still outstanding at the time is what we're listing currently on the balance sheet. And then same with long-term debts. Those are loans to long-term assets, typically land, buildings, some of those things that have an original term greater than 10 years.
Intermediate assets would also include breeding livestock, things like that as well.
Say that again, Denny. I'm sorry, I didn't hear that very well.
Intermediate assets would also include things like breeding livestock, something that's not going to be sold within 12 months.
Good point. Yes, thank you. Then just one other term you may have heard that we wanted to point out today is the fact that in some instances, intermediate and long-term are combined and just considered non-current assets and liabilities. So if you hear that term or think of, know of that term yourself, that's just a larger category. So in general business, that's often how it's referred to. In agriculture, we get a little more specific in that process oftentimes and break down the intermediate and long-term. The other piece there then is personal. Like I said at the onset, if you are a sole proprietor, which many farm operations are, then listing your personal assets and liabilities separately can also be included on your balance sheet, but you'd put those in the personal category and separate those from the different business assets and liabilities that you have. Then as we consider and continue to think about our balance sheets and complete the right-hand side of it, all the liabilities then are totaled up to come up with a total liability outstanding. And then we calculate the net worth. So assets minus liabilities gives us our net worth. And the balancing piece then there is the fact that assets on the left-hand side with the total liabilities and net worth on the right-hand side will always equal, will always balance out. So hence the name and the graphic here. And as you prepare your own balance sheet, you can do this simple T-chart as well and list out the things you own on the left and the liabilities that you have on the right, and then determine that net worth at the bottom. I already said you can prepare a balance sheet each day of the year, and it's going to be a little bit different. And you can certainly do that. You can do a balance sheet any day of the year. Our recommendation is to at least do it once a year, and the most useful over time to help you track how things are progressing in your operation is to pick a certain day of the year to do so. Our recommendation would be to do that at the end of the year. So then you're preparing your balance sheets and you're preparing your tax statement or taking a look at the income statement, like we'll talk about next week, and everything can tie together. That helps your lender, that helps you. It also helps you establish some trends as you look over time at your balance sheet. It's also useful though to consider your balance sheet at different times throughout the year, maybe quarterly, maybe on a semi-annual basis, depending on the complexity of your operation. But that just helps you look at progress more quickly as well, so you can see how things are changing within the year and not waiting just until the year end.
If I can add to,
sometimes,
it might seem on the annual thing, year end, I as a retired banker, with all the customers I work with, I just begged them to get these numbers put together at year end. It doesn't mean that on December 31st, it might seem obvious, but I'll say it anyway. It doesn't mean that you have to, okay, I've got to take a couple hours out today to do this balance sheet because it's a busy time of the year. But a few days later, for instance, now, even 3 weeks beyond that date, some of those inventories, unless you're into some type of project or farming operation that turns a lot of inventory, it's not too late to do it, but you can do it as 12/31. But please do it a few days or just a few weeks beyond the 31st, so that, because as the inventories are fresh in your mind. Again, that may seem obvious, but I wanted to make that mention to have it annually, because we're going to talk about Schedule F during this 3-hour process, and that Schedule F is going to be most likely be from January 1 to December 31st. The balance sheet needs to be the same, and so get it done as soon as you can after the first of the year. Sorry to rattle on. Thanks, Polly.
Nope, great points, Denny. Yes, do your best and try to do it there at the end of the year. So that's a look at putting the balance sheet together. Now we just want to talk about analyzing the balance sheet for a couple of minutes. Once you've put it together, how do I take a look at it and determine if it's good, bad, or indifferent? So we're going to talk about 4 different pieces of that. We're going to talk a little bit about liquidity, just balance sheet structure in general, solvency, and net worth change. So maybe some new terms here. First of all, liquidity, which really is taking a look at the working capital of the operation and determining if there's enough of it. Working capital, if you are unsure what that is, it's current assets minus current liabilities. So it's the very top left and right segments of your balance sheet, taking those totals and looking at what's left over. That would be the working capital. So the question always is, how do I build working capital? How do I grow working capital? This may seem simple, but it starts off by making money. Pretty straightforward there. And then the real key is don't spend all of it, which can be easier said than done. And how do we spend money, or what gets us in trouble when we're building working capital? Well, first of all, it can be that I have a lot of family draws happening and my business can't support that. So I need to look at supporting my family in other means, another source of income or something like that. And that may not be the problem. The other problem may be I'm using cash to finance things like a truck, like we see on the screen, those capital assets that really we should look at taking a loan out for a portion of it and not using up all of our cash to make these big purchases. So that's the typical strains that we see on working capital. Certainly, as you have too much debt and all of that, that can certainly make a big impact as well. But if we're just looking at how to build cash, those two are typically big drains.
And in the analysis piece, if I could add to that, the working capital is always, it's always been there, if you will, and something of interest to both the borrower, the farmer, as well as the banker. But never more so than perhaps in the last 4 or 5 years, when things haven't been very profitable in the ag sector, most of the ag sectors. That working capital has been depleted in a lot of cases. And so when it comes to analysis by the lender, or in my case, because I was part of a regulated bank, by the comptroller of the currency, their big emphasis and the bank's emphasis has been on a positive working capital. So it can't be overstated how important this is, and especially in times that have more adversity than others, such as the last few years.
Right, definitely. The reason to build the working capital, just to say it a little bit different than what Denny said, is that cushion. So when things aren't as rosy and things are tighter, then we have something to fall back on and help support the operation in those more challenging times, less profitable times.
The rainy day fund, right?
Yes, good way to say it, rainy day fund. The other piece here is balance sheet structure, and there is no right answer. Liquidity, lenders will have a number, typically 1.25, so $1.25 of assets for every $1 of liability is kind of a minimum. Balance sheet structure doesn't have just a straight metric like that. But really what you're doing in each of those segments, whether it's current, intermediate, or long-term, you're looking at the equity position or what's left over. We talked about working capital on the liquidity or current side, but you can do the same thing in the intermediate and long-term side as well. So it's just making sure you have equity that it's equally proportioned. So again, making sure financing matches the asset type if that's needed, and just not straining one section of the balance sheet more so than others. Anything you want to add there, Denny, or does that summarize that?
Sitting here thinking through that, and no, it's absolutely correct. It rarely happens that way because all too often, as I can maybe relate back to the last 5 years, our working capital became short. It's been really important because in essence, it became lopsided, if you will. Current assets weren't sufficient enough to meet the current liability piece, and so you had to drop down to try to get a real estate loan, perhaps on the land, to shore up that working capital in the form of cash into the asset side. So without getting too deep into that, it's a well-balanced balance sheet is almost utopia, but rarely can be achieved because you're constantly trying to figure out how to balance that asset against the debt that's against it.
The other piece then is just solvency as a whole. Solvency is looking at the overall financial risk of the business. So Denny talked a little bit about collateral earlier. So it's the borrowing capacity, it's the assets versus liability, and then the net worth that's left over. If you were to look at a ratio or look at a calculation to evaluate and identify solvency, you would look at one of the three items here. My mind, and I think a lot of producers' minds, gravitate towards debt to assets. I'm looking at how much debt I have versus the assets that are within the business. So I can see what I like to say then, that ratio shows how much does the bank own of your business versus how much you own of your business as you evaluate that. So hopefully you own more than the bank does over time. That will put you in the correct trend position and financial position for your business. But that's how you're evaluating solvency. If I sold all my assets today, could I pay off all the debts and have some money left over? And really, these other two ratios are just different iterations of how we're looking at the balance sheet and doing that calculation. So similar but different, basically.
Key here is to pick one, and then so as not to be comparing apples to oranges year after year. Stay with that ratio, so you have a road marker in that road in your journey.
And then the last piece here, again, is just to consider net worth change. So what kind of progress as you do a balance sheet over time, several balance sheets over several years, you can start to see the progress you've made. Debt to asset ratio improves. I've gained liquidity. I've paid off debt and gained assets in that process. So that overall progress of the business it means if our net worth is growing, that our earnings, what the business is earning, is greater than what it's consuming to pay debt, to help support my family, all of those things. So that's really the goal there. The other option, like we talked about before, and not to get into the weeds too far, but we can always increase market values in order to hide some of that and make things look better than they really are. So again, being conservative in that asset valuation will help us get a real look at net worth progress, net worth change over time.
Yeah, a really classic example of that is the last few weeks. If you're a grain farmer in the Midwest, which is where I happen to be how I live, it's a fun time to come in and do your balance sheet because corn and soybeans have increased dramatically in value. Again, it's one of those deals where it's a point in time. And so unfortunately, if you hit the high of the markets today, it may look a little rough to deal with in comparisons a year from now if the markets didn't hold, and they may or may not. So it's an interesting time when you use market value on the balance sheet because again, it's a point in time, and can be a little sometimes. And it can happen the opposite too. Market values drop, and you have to go in to do your balance sheet or bring your balance sheet to your lender. It could get pretty tough.
Mm-hmm. Right. So taking a look. Taking a look at those prices and on those current assets, on those commodities, and can I make money today? So let's capitalize on it too. That's a whole nother discussion, but good point. So that concludes just a basic overview of balance sheets and helping you determine where you're at as a producer, how I put together a balance sheet, and how I start to analyze that. And like I said, we'll share some tools in the last session. If you're needing more help than this in that process, we'll point you to those, but just wanted to get you started thinking about where to start if you're a brand new producer looking at needing some financing, or just how do I begin to analyze my business. So with that, I will stop sharing my screen here. Not sure if there's any questions from anybody at this point. I don't see any that have been chatted in, but certainly we'd take a couple minutes to answer those, or you can certainly reach out after the fact as well and get in touch with us. So, and I don't know, Jackson or Christopher or Pete, if you have anything to add to that discussion, we'd certainly welcome that as well.
Even with a lot of our small businesses, you highlighted there about some additional pickup cost expense and things of that sort, and kind of your personal expenses taken away from the stability of your operation. We run into that quite a bit, and it is really good to have a well-balanced family budget and really stick to it. So that was good. So I'm glad. Yeah, it's just not only it's all in all sectors, even, nobody's perfect when it comes to budgeting.
Yes, we have a professor that I've listened to quite frequently from Virginia Tech, and he's talked about killer toys and that piece of it and the personal expenses. And it does fit in some instances because it can drain out that working capital hole from the immediate.
Definitely. So it's good to have a roadmap of how you're going to spend your money. I know I do it in my house. I know a lot of you all do it. So a good thing, good practice to do.
Nobody ever said it was easy.
No. Do you have anything to
Would
add,
we want
Jack?
to talk about what we're doing next week before we close?
Sure. Were you going to say something else, Jackson? Okay. So next week we'll meet at the same time, 2:00 Central, next Wednesday. We will have Rob Holcomb join us. Some of you may have heard from Rob before. He, I think, has talked in he's a resident tax expert on our team, and I know he's talked at different conferences and all of that. So he's going to give an introduction to Schedule F and the importance of completing a Schedule F if that's perhaps a new activity for you and your operation, but what other doors it may open if you're considering doing that and why it might be important for your operation. Okay. Well, thanks for joining us. Yeah, thanks for joining us thus far. Appreciate that. Like I say, we'll share the recording and feel free. I hope it works for you to join next week again as well. So,
Thank you.
Thank you.
Thank you, everybody.